In the world of trading, there are legends, names whispered in hushed tones on trading floors. But what if I told you there was something even rarer than a legend? A secret bloodline, a mentor chain so powerful, so carefully cultivated that it produced not one, not two, but three of the greatest traders who ever lived. This isn't a story about one trader making millions. It's the story of a dynasty, a passing of the torch across generations. And it all starts with a reclusive genius named Ed Seykota, a man who turned $5,000 into $15 million and pioneered computerized trading systems before most people had ever touched a computer. Seykota took under his wing a young, struggling, emotionally volatile trader named Michael Marcus, a man who had already lost everything. Twice, a man who was on the verge of giving up entirely. And Michael Marcus, once he had absorbed the wisdom of his master, went on to mentor another struggling trader, Bruce Kovner. Kovner would go on to found Caxton Associates and become one of the wealthiest hedge fund managers in history, with a net worth exceeding $6 billion. This is the story of the greatest mentor chain in trading history. And at its center, the crucial link that connected the pioneer to the billionaire is Michael Marcus, the man who turned $30,000 into $80 million. The man who learned that trading isn't about being smart, it's about being wise. How did this one man, who nearly destroyed himself with reckless gambling, not once but twice, transform into one of the most disciplined and successful commodity traders of all time? The answer lies in the lessons passed down from his master. Lessons about patience, about risk, and about the terrifying, liberating power of letting go of your ego. Before the $80 million fortune, before the corner office at Commodities Corporation, before he became a legend interviewed in Market Wizards, Michael Marcus was something far more ordinary. He was a research analyst at a brokerage firm with a dangerous hobby, trading his own money on the side. It was 1972. The markets were wild. Nixon had just implemented price controls, creating chaos and opportunity in equal measure. Marcus scraped together his life savings, about $7,000, and decided to try his hand at the futures markets. He had read a few books. He thought he understood the game. And at first, the market rewarded his ignorance. Nixon's price freeze sent plywood futures soaring, and Marcus was on the right side of the trade. His $7,000 became $12,000. He felt invincible. By 1973, through a combination of luck and aggressive betting, he had turned $24,000 into $64,000. He was convinced he was a natural-born genius. But the market has a way of humbling those who mistake luck for skill, and Michael Marcus was about to learn this lesson in the most brutal way possible. He heard a rumor about a corn blight, a disease that would devastate the crop and send prices skyrocketing. He bet everything. He went all in. The blight never materialized. The rumor was false, and Marcus watched in horror as his position collapsed. He lost a fortune. But he didn't learn. Not yet. He convinced himself it was bad luck, not bad judgment. So he did it again. This time with lumber futures. He bet everything on a big move. And this time, the government stepped in with an unexpected policy change that crushed his position overnight. He lost almost everything, again. He was at his absolute lowest point. The money was gone. His confidence was shattered. He questioned everything about himself. In his own words from his famous Market Wizards interview, "I would sometimes think that maybe I ought to stop trading because it was very painful to keep losing." He recalled a scene from the musical Fiddler on the Roof, where the main character Tevier, a poor milkman, looks up at the sky and has a conversation with God. Marcus found himself doing the same thing. He would look up and say out loud, "Am I really that stupid?" And in that moment of despair, he heard an answer. Maybe it was his subconscious, maybe it was something more. But the answer was clear. No, you're not stupid. You just have to keep at it. And so he did. But this time he knew he couldn't do it alone. He needed a teacher. He needed a master. That's when fate intervened. Working at the same firm was a man named Ed Seykota. Seykota was unlike anyone Marcus had ever met. He was brilliant, eccentric, almost mystical in his approach to the markets. And he was phenomenally, almost unbelievably successful. Seykota was a pioneer. In an era when most traders relied on gut instinct and tips from brokers, Seykota was building computerized trading systems. He was using early IBM computers to backtest strategies and remove human emotion from the equation. He was decades ahead of his time. Marcus watched Seykota trade. He studied his methods. He begged to learn from him. And eventually, Seykota agreed to take him under his wing. It was the most important decision of Marcus's life. The lessons Seykota taught weren't about hot stock tips or secret indicators. They weren't about finding the next big trade. They were about something far more fundamental: psychology, discipline, and the unwavering, non-negotiable laws of money management. The first lesson was patience. Seykota would hold a position for months, sometimes even years, even if it was barely moving, as long as the underlying trend was intact. He taught Marcus that the big money isn't made in the buying or the selling, it's made in the waiting. Marcus had always been impulsive. He wanted action. He wanted to trade every day. Seykota showed him that the best traders often do nothing. They wait, they watch. And when the perfect opportunity presents itself, they strike with overwhelming force. Then they wait again. The second lesson was systematic discipline. Seykota believed that emotional input was the enemy of good trading. Fear, greed, hope, regret. These emotions cloud judgment and lead to catastrophic decisions. So Seykota developed systems, rules, algorithms. He removed himself from the equation as much as possible. He taught Marcus to create a trading plan before the market opened, to define exactly when he would enter, when he would exit, and how much he would risk. And then, crucially, to follow that plan no matter what his emotions were screaming at him to do. The third and most important lesson was money management. This was the key that unlocked everything. Seykota drilled into Marcus the importance of position sizing and risk control. It wasn't about how much you could make, it was about how much you could lose and still survive to trade another day. The most critical rule Marcus learned from Seykota was devastatingly simple. Always bet less than 5% of your money on any one idea. This wasn't just a guideline. It wasn't a suggestion. It was an unbreakable law. Why 5%? Because it ensures survival. Marcus explained it this way. That way, you can be wrong more than 20 times in a row, and it will still take you a very long time to lose all your money. It was the antidote to the all-in bet-the-farm mistakes that had nearly destroyed him twice. Think about what this rule does psychologically. It removes the pressure to be right on any single trade. It forces you to think in terms of probabilities, not certainties. It kills the ego that demands you prove your intelligence with every position. When you can only lose 5% on any one trade, you stop caring about being right. You start caring about being disciplined. Survival becomes the primary goal. Profits become the secondary, almost inevitable byproduct of survival. This rule transformed Marcus from a gambler into a trader. It was the foundation upon which his entire $80 million fortune would be built. And it's a rule that every trader watching this video should tattoo on their forearm. But the most painful and powerful lesson Marcus learned from Seykota didn't come from a lecture or a book. It came from watching and suffering. It came during the great soybean bull market of the early 1970s. Soybeans were in a historic bull run. Prices were rocketing from $3 a bushel toward an almost unimaginable $12. Both Marcus and Seykota were long. They were both making money. But Marcus, still carrying the scars of his previous losses, was nervous. When soybeans had doubled, Marcus decided to take his profits. He got out. He thought he was being clever. He thought he was being disciplined. He had made good money. Why be greedy? Seykota, his mentor, stayed in. Why? Because the trend hadn't changed. The fundamentals hadn't changed. There was no reason to exit except fear. And Seykota didn't trade on fear. What happened next would haunt Marcus for years. For 12 consecutive trading days, soybeans went limit up. This means the price rose so fast that trading was halted. Marcus couldn't get back in even if he wanted to. The market wouldn't let him. Every single day, Marcus had to walk into the office and see Seykota, his mentor, still in the trade, still making money. Obscene amounts of money. While Marcus sat on the sidelines watching his former profits multiply without him. I dreaded going to work, Marcus later admitted. Every day I would come in and Seykota would be in the trade that I had gotten out of. It was agonizing. This experience burned a crucial lesson into his soul, a lesson he would never forget. The lesson was this: if you don't stay with your winners, you are not going to be able to pay for the losers. In trading, you will be wrong often, maybe even most of the time. The only way to make money is to make sure your winners are so big that they overwhelm your losers. And you can't do that if you cut your winners short. Armed with Seykota's wisdom and scarred by the soybean agony, Marcus developed his own signature approach to the markets. He called it the 3 confirmations. He would only take a trade, only risk his precious capital, if it had all 3 things going for it. The first confirmation was the fundamentals. There had to be a clear, identifiable imbalance of supply and demand that could fuel a major move. A drought threatening crops, a war disrupting oil supplies, a currency crisis, something real and powerful driving the market. The second confirmation was the technicals. The chart had to agree with the fundamentals. The price had to be moving in the direction his fundamental analysis suggested. If he was bullish on corn because of a drought, the price of corn had better be going up, not down. The third confirmation was the market tone. This was the most subtle and perhaps most important. When news came out, the market had to react in the right way. A true bull market should shrug off bearish news and explode higher on bullish news. If bad news comes out and the market doesn't go down, that tells you something profound about the underlying psychology. Marcus believed with absolute conviction, if you can restrict your activity to only those types of trades where all 3 confirmations are present, you have to make money, in any market, under any circumstances. It was a filter that eliminated the noise and focused only on the highest probability opportunities. By the late 1970s, Marcus was no longer just an apprentice. He had absorbed the lessons of his master. He had developed his own methods. He had built a track record of extraordinary returns. He became an executive vice president at Commodities Corporation, one of the most prestigious trading firms in the world. And now it was his turn to pass on the torch. The mentor was about to become the master, and his apprentice would be a young man named Bruce Kovner. Kovner was brilliant, a Harvard graduate, a former political campaign manager, a man of immense intellectual curiosity. But when it came to trading, he was making all the same mistakes Marcus had once made. He was over-leveraged. He was emotional. He was on the verge of blowing up. Marcus saw something in Kovner. He saw the raw talent. He saw the hunger, and he saw himself years earlier, desperate and lost. So Marcus took Kovner under his wing, just as Seykota had done for him. The mentor chain continued. He passed down the sacred lessons, the 5% rule, the importance of letting winners run, the 3 confirmations, the systematic discipline that removes emotion from trading. Everything Seykota had taught him, he now taught Kovner. Together, Marcus and Kovner made history. In 1978, they noticed something strange. The US dollar, which had been plummeting for weeks, suddenly started getting mysteriously strong. There was no news to explain it, no announcement, no obvious reason. Most traders would have ignored it or rationalized it away. But Marcus and Kovner had learned to trust price action over narrative. If the market was telling them something they didn't understand, they listened first and asked questions later. They immediately bailed on their anti-dollar positions. It was uncomfortable. It felt wrong. But they did it anyway. That weekend, President Carter announced a massive dollar support program. Had they waited even one more day, they would have been, in Marcus's words, annihilated. The lesson Marcus drew from this experience was profound. The big players, including the governments, would always tip their hand. If we saw a surprise price move against us that we didn't understand, we often got out first and looked for the reason later. The market knows things before you do. Respect that. What truly separated Michael Marcus from the thousands of other traders who tried and failed was his deep understanding of courage. Not reckless bravado, not blind aggression, but true, disciplined courage. He defined it in 4 distinct parts. First, the courage to try, to put your capital on the line, to put your ego on the line, to step into the arena knowing you might fail publicly and painfully. Most people never even get this far. They talk about trading, they read about trading, but they never actually risk anything. Second, the courage to fail, to accept losses not as personal judgments on your intelligence or worth, but as an inevitable part of the process. Every great trader has losing trades, every single one. The courage to fail means taking the loss, learning from it, and moving on without emotional baggage. Third, the courage to succeed. This might sound strange, but it's perhaps the hardest courage of all. It means holding on to winning trades, even when every fiber of your being is screaming at you to take profits. It means not snatching small gains out of fear that they might disappear. It means letting your winners run. And finally, the courage to keep going when the going gets tough, to persevere through the inevitable losing streaks, to show up the next day after a devastating loss, to maintain discipline when discipline feels impossible. This is the courage that separates the legends from the forgotten. Marcus believed that trading success wasn't about being right all the time. It wasn't about being the smartest person in the room. It was about having the psychological fortitude to endure the journey, the courage to fail and fail again until you finally succeed. As Marcus matured as a trader, he came to a profound realization. Trading requires managing not one type of capital, but two. And most traders only think about the first one. The first type is obvious: financial capital, the money in your account, the chips on the table. Without financial capital, you can't play the game. This is what everyone focuses on. This is what everyone tries to protect and grow. But the second type of capital is just as important, maybe even more so. Mental capital, your confidence, your discipline, your emotional energy, your belief in yourself and your system. When you suffer a big loss, you don't just lose money. You lose something far more precious. You lose the will to trade effectively. Marcus warned all who would listen. Losing either your financial or mental capital will knock you out of business, so you must protect both equally well. This is why the 5% rule was so critical. It wasn't just about protecting his bank account. It was about protecting his mind. A 5% loss is painful, but manageable. You can come back from it psychologically. A 50% loss, that destroys something inside you. It makes you doubt everything. It makes you afraid to pull the trigger on the next trade. It depletes your mental capital even faster than your financial capital. Marcus also learned the importance of balance. If trading is your life, it is a torturous kind of excitement, he said. But if you are keeping your life in balance, then it is fun. Trading is actually a lot of fun if you have other things going on in your life. He found interests outside the markets, hobbies, relationships, things that gave him perspective. And paradoxically, this made him a better trader. When trading isn't everything, you can trade without desperation. You can think clearly. You can follow your rules. One of Marcus's most practical and immediately applicable pieces of advice was for those moments of confusion. Those times when you're in a trade and you just don't know what's going on. The market is moving in ways you don't understand. Your thesis seems broken, but you're not sure. What do? Most traders freeze. They hope, they pray, they hold on, paralyzed by indecision, watching their losses mount while they wait for clarity that never comes. Marcus's answer was simple and direct. If you become unsure about a position and you don't know what to do, just get out. You can always come back in. This sounds obvious. It's not. In the heat of the moment, with money on the line, getting out feels like admitting defeat. But Marcus understood something crucial. You cannot think clearly while you're in a losing or confusing position. Your judgment is clouded by hope, by fear, by ego, by the desperate need to be proven right. Getting out clears your head. It gives you perspective. When you get out, then you can think clearly again, he advised. I've done that lots of times, and the next day everything was clear. I could see what I should do. It's a simple rule that can save you from catastrophic losses born from indecision and paralysis. Michael Marcus passed away in 2023, leaving behind a legacy that extends far beyond his personal fortune. He left behind a way of thinking about markets, a philosophy of trading, and most importantly, he left behind the traders he mentored who went on to mentor others. His journey from a reckless gambler who lost everything twice to a disciplined master who turned $30,000 into $80 million is a testament to two things: the power of mentorship and the relentless, humble pursuit of self-improvement. The mentor chain he was part of is the stuff of legend. Ed Seykota, the pioneer who proved that systematic, computerized trading could generate extraordinary returns. Michael Marcus, the master who refined those lessons and added his own wisdom about courage and psychology. And Bruce Kovner, who took everything he learned from Marcus and built Caxton Associates into one of the most successful macro hedge funds in history. The torch was passed, the knowledge survived, the dynasty continued. Marcus proved something that gives hope to every struggling trader watching this video. Trading isn't just an innate gift that you either have or you don't. While the very highest levels may require a special talent, Marcus insisted that to be a competent trader and make money is a skill you can learn. His story teaches us that the path to mastery isn't walked alone. It's paved by the wisdom of those who came before us, by the mentors who see our potential when we can't see it ourselves, by the teachers who share their hard-won lessons so we don't have to learn everything the hard way. So the next time you face a devastating loss, remember Michael Marcus. Remember the fiddler on the roof. Remember the man who looked up at the sky and asked, "Am I really that stupid?" And remember the answer he received, "You are not stupid. You just have to keep at it. Find your own Ed Seykota. Learn the rules, follow the rules, protect your capital, both financial and mental. Have the courage to fail, have the courage to succeed, and never ever stop learning." That is the legacy of Michael Marcus. That is the lesson of the mentor chain. And now that wisdom has been passed to you,